Welcome back in Unit 2 of Monetary Policy, and now we're ready to talk about monetary policy tools. First tool that we are going to talk about is open market operations. Before we talk about open market operations, let's talk about the government and how does the government finance its deficit. So the government will actually finance its operation through collecting revenues, either to be taxation or other kind of ransoms, and it will use the money to make expenses, build roads, finance grants, subsidies, etc. What if the revenues is not enough to finance the expenses? In this case, the government will grow deficit, and when the government grow deficit, they have to ask for loans. The loans of the governments are usually huge, that they are actually no one person or one institution can cover for the government debt. So it has to divide this debt into a small portions, those small portions called bonds. Bond is a piece of paper that actually guaranteeing the money you gave the government in order to, in the shape of loan. It will state how much did you give the government, what interest will the government pay you back, and when it will pay you back its debt. So, for example, this is an example of a bond, an American bond. You can see the value of the bond, what is the interest rate, when the government will be paying back your bond. However, in some countries, this bond can be resold in the stock market, so you can sell it to another person before its maturity, and you can recollect your money again. And here comes the open market operations. The open market operations actually is the management of the central bank for the government debt. So the central bank will use the government debt to influence the quantity of money in the economy. So let's say that there is a recession and the central bank wants to increase the quantity of money. So what will happen is the central bank will intervene into the market as a buyer for bonds. So it will announce that I want to rebuy the government bonds. So the central bank will buy the bonds and will actually give the money for the people and the banks. The banks will find that their reserves of money is increasing, money supply is increasing, so they will start decreasing interest rate. As they decrease interest rate, this will encourage more consumption and more investment. On the other hand, if we have inflation and we have high prices, economy on a heat, so we want to decrease the quantity of money in the economy. So the central bank will start playing the role of a seller. It will offer extra bonds, so people will buy the bonds and the central bank will collect the money. Banks will find itself with less reserves, and as they find themselves with a risk reserve, they will start increasing the interest rate, and when they increase interest rate, this actually will discourage consumption and investment. So open market operations plays a role in increasing and decreasing the quantity of money on the society. Let's talk about the second tool, which is the discount rate. We remember from our previous chapter that banks has to keep part of its deposits as a reserve. They cannot loan it, and this part is determined by the reserve ratio, and this reserve ratio is actually levied by the central bank. So what if one bank went down in its reserve? It's now under the required reserve ratio. The bank has to make a loan to recover this deficiency, and this loan comes at an interest rate called the discount rate, either to take this loan from other banks or to take this loan from the central bank. So if the central bank wants to treat recession, increase the quantity of money, they will start reducing this discount rate. So banks will be encouraged to make more loans, increasing the quantity of money in the society. This will lead eventually to an increase in demand, increase in GDP, and maybe accelerating inflation rate. And vice versa. If we have inflation, so the central bank will start increasing the discount rate, loans will go down, money supply will go down, there will be a decrease in the inflation rate and maybe a decrease in the economic growth. The third tool is the required reserve ratio. The required reserve ratio is the percentage of the deposits that the central bank mandates banks to keep in cash. They are idle money. The banks cannot loan them. So if we are in recession and we are trying to increase the quantity of money, the central bank will decrease the required reserve ratio. By decreasing the required reserve ratio, money supply will increase. As loans increases, this will increase the demand, GDP, and increase inflation, and vice versa. If we have inflation, we are to increase the required reserve ratio. This will decrease loan, decrease the quantity of money, and decrease demand, GDP, and inflation. Now, let us summarize what we have just said and to add a small piece of information over the effect of the money or the monetary policy over the exchange rate. Here in our panel, we can see in pink the expansionary policy. What do you mean by expansionary policy? Expansionary monetary policy refers to a policy that tries to increase the quantity of money and reactivate the economy, tries to get the economy out of the recession. So expansionary policy will start in our example by the Fed buying securities from the open markets. This will actually increase the reserves of the bank, leading the interest rate to go down. The lower interest rate will actually cause consumption to increase, investment to increase. And it also have an indirect effect over the exchange rate. So lower interest rate meaning less value of the domestic currency. And as we remember from our past examples, that lower value of the domestic currency will lead to a higher exports and lower imports. Let's take an example, the example that we see by the left here. Here we're talking about a trip to Sharm el-Sheikh that will cost 5,000 Egyptian pound. If the exchange rate for the Egyptian pound is 10 pounds per euro, this trip will be for 500 euros and 1,000 people will be interested to take it. If the Egyptian pound value is to go down to 20 pounds per euro, this means that the price of the same trip will be 250 euros and 2,000 people are now interested. So what happened here? The number of people interested in this trip has increased. If the value of the pound went down even further to 50, the trip is for 100 and the people interested are 7,000. So our sales of this trip is increasing, which means our exports is increasing. The opposite story will be for our imports, as if the value of our domestic currency is going down, this means that the imports prices are going up and the value of these imports is to decrease. So the falling interest rate will increase consumption, will increase investment, and will increase also exports and decrease imports. All of these changes mean that the aggregate demand is increasing, causing the GDP to increase and maybe also causing the inflation rate to speed up also. Now let's talk about the right side of our slide, the contractionary monetary policy. Contractionary means that I want to decrease the quantity of money, I want to control inflation. So the Fed here will go as a seller for bonds, meaning that it will collect the money and give the market the paper. Here we have the reserves of the banks will go down. This will lead the banks to increase the interest rate. By increasing the interest rate, consumption will go down, and investment will go down, this will cause the currency value to go up, and this will actually decrease exports and encourages imports. So there is a decrease in the C, consumption, decrease in the I, investment, decrease in exports, and increase in M, imports. So all of this will lead to a decrease in aggregate demand, causing the GDP to go down and inflation rate to slow down. Now, at this point, we know about the monetary policy, we know about the role of central bank in influencing the interest rate, what are the tools that the central bank is using to influence the interest rate. I'm gonna give you some tips about how to use this space of information, maybe to rationalize your personal finance decisions. Well, you have to watch interest rates closely. It affects your life and your financial life. If you are expecting interest rate to decrease, make a loan at a variable rate. You can make a loan on a variable rate or on a fixed rate. On a variable rate means that if there is a change in interest rate in the market, it will reflect over your loan. So if we are expecting interest rate to go down, go with a variable interest loan. And if you are expecting that the interest rate will go down, go with a fixed interest rate for your deposit, because you don't want to have your deposit interest rate to go down when the prices go down in the market. Keep an eye on interest rate because they represent the minimum return over your investment. So if you are considering an investment to do, you have to compare the expected rate of return to the interest rate in the bank. At this point, we are done with monetary policy. Waiting for you in the next chapter.